Introduction. In capital budgeting, the cost of capital represents the minimum required return necessary to make a capital investment worthwhile. It acts as the discount rate used in net present value, NPV, internal rate of return, IRR, and other discounted cash flow, DCF analyses. Understanding the components and calculation of the cost of capital is essential because it reflects the opportunity cost of investing capital in a specific project rather than in alternatives. It serves as a benchmark for evaluating project profitability. It affects the firm's financial strategy, debt equity structure, and long-term value creation. Components of the cost of capital. Here's 1. Cost of debt, CAD. Cost of debt is the effective rate a company pays on its borrowed funds. It must be adjusted for tax since interest payments are tax deductible. Formula after tax, KD KDX, 1.T text, after tax, KD n times 1T, where K is cost of equity, T, corporate tax rate debt, is generally cheaper than equity due to the tax shield, but excessive debt increases financial risk. 2. Cost of equity, KE. This is the return required by equity investors to compensate for their risk. It can be calculated using various methods. A. Capital Asset Pricing Model, CAPM, KRF plus RMRF, KERF plus A beta, RMRF, where RF is risk-free rate, e.g. treasury bills, V, beta coefficient, volatility of stock relative to market, RM, expected market return, B, dividend discount model, DDM, KIC D 1P0 plus KE, then FRAC D1 1P0 plus G, where D1 expected dividend, P0 current share price, G 0 growth rate in dividends. 3. Cost of preferred stock, KP. KP falls DPKP NFR DP, where D is annual dividend, P is market price of preferred shares. Preferred stock is less risky than equity, but more expensive than debt due to lack of tax deductibility. Weighted average cost of capital, WACC. The weighted average cost of capital, WACC, is the average rate a company is expected to pay to finance its assets, weighted by the proportion of each source of capital, debt, equity, preferred stock. Formula WACC, EVSK plus DVXKDX, 1T, plus PVSKP, WACC, ERSD in left, NAFRAC E, V times KE right, plus E left, LEFRAC D, V E times KD here times 1T E right, plus A left, LEFRAC P, V E times KP E right, where E, market value of equity, D, market value of debt, P, market value of preferred shares, V, E plus D plus PK, KD, KP, cost of equity, debt, preferred, T, tax rate. WACC is the standard discount rate for evaluating investment projects with similar risk to the firm's average operations. Marginal cost of capital, MCC. The marginal cost of capital represents the cost of obtaining an additional unit of capital. It rises with each additional unit of capital due to exhaustion of low-cost funding sources, increasing investor risk perception, restrictions from lenders or markets. The MCC schedule is used to determine how cost changes at different capital levels and whether new investments are worth pursuing. Common errors in estimating cost of capital: using book values instead of market values, applying firm-wide WACC to projects with different risks, ignoring flotation costs, costs of issuing new securities, using historical returns instead of expected returns, misestimating beta coefficients, project-specific versus company-wide cost of capital. A single WACC may not be appropriate for every investment. For example, a higher risk project, e.g. international expansion, requires a higher discount rate than the average WACC. A low-risk project, e.g. upgrading existing facilities, may justify a lower rate. Project-specific cost of capital is estimated by adjusting the firm's WACC based on project beta, proxy using comparable firms, country risk premium for foreign investments, inflation differential and currency risk, and adjusting WACC for risk, inflation, and capital structure. Leverage affects both cost of equity and WACC. Increased debt raises financial risk and equity costs. Inflation must be reflected in the discount rate if using nominal cash flows. Country risk premium, CRP, is added to WACC for projects in volatile environments. For multinational firms, WACC must be tailored to reflect different economic and financial conditions per region or sector. Strategic role of cost of capital. A well-calculated WACC guides capital budgeting decisions, impacts valuation of the firm, influences strategic planning and financial policy, determines shareholder value creation. A misestimated cost of capital can lead to accepting poor projects or rejecting good ones, directly affecting long-term competitiveness. Summary of key points. Element purpose adjustments. 1. Cost of debt rate on borrowed funds after tax. 2. Cost of equity return required by shareholders, CAPM or DDM. 3. Cost of preferred fixed dividend returns, not tax deductible. 4. WACC overall, hurdle rate market value weights. 5. MCC, cost of new capital, increases with volume. 6. Project-specific cost, risk-adjusted rate. Beta, country, inflation. Summary of cash flow components. Category, description and cash flow timing. 1. Initial outlay asset purchase, installation, WC, year 0, 2. Operating cash flows, revenues, expenses, taxes, plus. Depreciation years, 1, N, 3. Terminal cash flows, salvage, plus WC recovery, exit costs, final year.